Hello traders, welcome back to the Forex gig where we will dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the Zigzag indicator and how to optimize its settings for maximum trading efficiency. This isn't just about tweaking numbers, it's about understanding how these settings can reveal market trends and enhance your trading strategy. So stick around until the end of this video to learn the specific setting used by professional traders across various markets and see how they can apply them to their own trading setup. Alright, we have to first of all start by understanding the zigzag parameters. The zigzag indicator operates on three fundamental parameters that determines its effectiveness in identifying market swings and trends. The first parameter is its depth, which is set at 12 by default. And this area is set by 12 at default. This setting determines how many candles or how many candlesticks the indicator analyzes to establish specific pivot points in the market. This is the different area. This is where we make that setting known. When using the lower depth value, the indicator becomes more sensitive to price movement, creating more zigzag lines. The higher depth value produces fewer lines but captures more significant market moves. The second parameter is the deviation, which controls the minimum percentage. This deviation controls the minimum percentage of price movement required before the indicator draws a new line. This setting acts as a filter for market noise. So this is what it's about, and we'll set that to 5. Now we have to notice how the 5% deviation settings create a cleaner trend. This is how the trend, while set on the indicator using a 5% deviation. As we can see from the setting of this particular screen, we are using a 5% for price deviation, and we can see how it's creating a cleaner trend in this chart. And you can notice it filters out the minor price fluctuation, while on the other hand, on a 1% setting, it captures smaller price market movement but introduce more noise in the market. Now the third parameter is the back step, and this back step is actually set to defaulting. It is set to defaulting by I will try to show you what I mean. It's set to defaulting by 3. It has already been set on the indicator. This setting determines the minimum numbers of bar that must form between swing highs and swing lows. This is what it explains in the chart. The minimum amount of bars that will be set in the chart, which has already been set on this indicator. Now let's see how different markets exhibit unique volatility characteristics requiring specific zigzag setting for optimal trading identification. This is going to now looking at the daily time frame on this chart. It shows how forex trading uses an optimal deviation setting falling between 3 to 8%. It has to be between 3 to 8%, but at this area we're making use of 5. While when we are making use of stocks, if we are trading using stocks like let me change our chart to a stock chart. Stock like the Euro S, we have to make use of higher deviation settings. We have to use higher deviation settings such as between 8 to 10. So we'd have to increase our deviation setting from 8 to 10. So we'll make use of 9 and we'll see it will lessen out the price, making it a bit more cleaner. This stock chart is a bit unclear, so look for a better stock chart. Perfect. This is a perfect stock. It needs a setting of higher deviation to make it to show us or help us filter out the natural price swing and enhance with the equity of the market. This is what it shows on a stock chart. While for future trading, the optimal deviation setting fall between 3 to 8. This range effectively captures the minimum volatility nature of the futures market while maintaining the signal clarity. So I'll take this back to our Euro chart. Our Euro USD. You will notice from this example, from the examples we spoke about, we will notice how lower deviation settings, in the forex market creates a cleaner trend. As you can see, I changed our deviation setting back to 5, and we can see in this forex market the lower deviation setting, which is the 5%, creates a cleaner trend in the forex market, a cleaner trend line without excessive noise. This precision is crucial for identifying key support and resistance level in currency trading. When applying this setting, maintain the default depth of 12 and a backstep of 3 across all markets. These base parameters provide consistent trade identification. It provides consistent trend identification while the deviation adjusts the amount for the account for the market specific volatility. So we would have to look at the common mistakes we need to avoid while taking this zigzag pattern or while setting up this zigzag indicator. We have to first examine the most dangerous mistake traders make with the zigzag indicator. There are 3 in number. The 3 most dangerous mistake traders make while making use of this indicator. The first one is being overly dependent on the indicators alone could lead to significant trading error. Many traders mistakenly use the zigzag as their primary decision making. They use this as their primary decision making tool when it should only serve as part of a broader analysis framework. This is what happens when you make use of just this indicator to take trade. You might want to take a trade here and price would break out of that zone. This indicator should always be combined with multiple indicators. Like you can make use of this indicator with your Fibonacci retracement. You make use of this indicator with your Fibonacci retracement to give you areas in market where you expect price to reverse from, and as we can see, price is showing us an area at this. Sorry, let me draw this Fibonacci in a very proper way. These are areas where we expect price to react from, the 38.20 level. So combining this indicator, the zigzag indicator, with other indicators makes it a more powerful tool. The second mistake is setting incorrect parameters. Setting incorrect parameters is another crucial error that can distort your market analysis. When traders set deviation values too low, they create excessive noise, while setting them too high means missing out vital market movement. So as we can see, from setting it to a standard of 3%, we can see it's showing us a proper market trend. But if I use a lower deviation, like let's say I change this deviation to 1, we can see it's showing us too much details. If I take it to a higher deviation, let's say I take it to 10 or 12, you will see how we would miss out or intricate details. It's not showing us a proper detailed chart. So we have to use a balanced deviation setting. This is what it means. The last mistake traders usually make is ignoring the market context. Is perhaps the most serious mistake or the most common mistakes traders make. The zigzag indicator doesn't account for fundamental factors, e.g. the economic events and the overall market sentiment. This oversight can lead to costly trading decisions, especially during significant market events such as FOMC or stronger news events. So we have to always check out for the market context, checking if there is any news in the market or any economic major news that might disturb the market behavior. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you would never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.